past questions, and is what is examinable. So can you check the WhatsApp page?
Okay.
I sent 2 questions.
Sorry, just to cut in. We won't start from valuation M&A, because this valuation M&A and corporate reconstruction is really, really tricky, like what I told him the last time.
Yeah. So for valuation, right? For business valuation, when you have it in a standard exam question, is related to merger and acquisition. You have it on a merger and acquisition question and reconstruction question. Business valuation will not stand alone. It's integrated into merger and acquisition. Do you understand?
Okay.
So at the professional level, you won't have valuation standalone. No. What you have in valuation is what you have in merger and acquisition, but at another level of getting the synergies both from individual valuations. I don't know if you understand what I'm saying.
No, but maybe as it goes on once.
Okay, maybe let's solve because so what I'm saying technically is this: for business valuation, right? Business valuation as a standalone, right? You need it for merger and acquisition because in the exam, you'll be having a full-fledged merger and acquisition question in which business valuation is embedded into.
Okay.
So in the exam, or you won't say anything like business valuation standalone. That business valuation you are saying, you need to achieve a merger and acquisition question. Do you understand now?
Okay.
Yeah. All right. So let's start, please. So I sent 2 questions. I trust that we'll be able to finish these 2 questions today. I also want us to touch advanced investment appraisal, right? I want us to touch advanced investment appraisal. I want us to do APV, because it's very important. It's needed for the exam, right? So APV, but let's see how far we can go on these 2 questions, and I want us to be quick about it so that we can cover on time. So can you open the question? We have Proplace Co and Addict Tanko. Let's start with that first.
Okay.
Hello, good afternoon. Sorry, my name is Akinola. Sorry to continue, please.
Okay, hi Akinola. Good afternoon.
Is that a question? This class is for the professional level, for the skill level. This is the advanced financial management or the normal financial management that is for skill level.
This is the advanced financial management.
Okay, that is at professional level, right?
Yeah, professional level, yes. Are you for the skills?
Financial class. For the skills, I thought it's for financial management.
No, this is not financial management. This is advanced financial management.
Yes,
so,
sir.
Yeah, hi. I have Otong. Okay. Hi, Otong.
Yes, sir. Yes.
I'm with you.
Otong, yeah.
Yeah, I'm with you, please. You want to say something?
Okay, sir. No, just go ahead. Just to let you know that I'm in.
Okay. Nice having you around. Are you for the advanced financial management?
Yes, sir.
Okay. Well, this is my first time hearing from you. Were you in the previous class with the other lecturer?
Yes, but not the recent one. That's the upper one before.
Oh, okay. All right. Nice having you around. Who again do I have on the call? I think it's only Z I know from my previous. I think I have Alkabiri. Alkabiri. Good afternoon. Good afternoon, Alkabiri. If you can hear me, Ostino. I think I've had Ostino in one of my early class. Ostino, good afternoon.
Good afternoon, sir. I can hear you.
Okay. Are you also for advanced financial management, please?
Yes, sir.
Okay. Are you on the AFM group?
That's why I joined.
Okay. Are you on the AFM group? I sent.
Right. Financial management. All right. Management.
Or let me drop the questions. Let me try and drop it here. For those, so we have 2 questions. Were you in the previous class with Emmanuel?
What's the right those 2 papers?
No, sir,
Anton, please, can you mute your? Anton, can you mute, please?
So what I'll do, I'll minimize something. Jesus. Oh.
Sorry, I have a question. Please,
Okay.
do we have some classes in between the weeks? We talked about it like
Yeah,
Wednesday. Tuesday.
you talked about it, but Z, you didn't prompt me. You remember I told you to prompt me during the week.
So work, everything was just a lot. It was even
Uh,
Wednesday evening. I kind of remembered, and I think we have like a month to go. Do you
yeah,
understand?
yeah,
And we have those theoretical aspects like finance decision. Those, you understand what
yeah,
I'm saying? Those
yeah. So
Islamic finance and the normal equity financing options.
you're right.
You
You're right.
understand?
And so
And
let's
advanced investment appraisal as regards foreign exchange, forex.
Yeah, so my plan is, like I said, my plan. So I'm going to be mixing merger and acquisition and the advanced investment appraisal, which covers APV and multinational, right? The foreign aspect of it, and and which I plan to complete this week. So yes, I have you in mind concerning that. So let's just agree. Should we do Wednesday?
Please, Wednesday.
Wednesday in the
But
evening.
you can also prompt others if they are interested. But Wednesday works for me.
Okay, so I think everybody's on the group right now. I have Otonga. I'm seeing people coming in, coming out. Alkaberry is off. Squitchy. Good evening.
Yeah, good afternoon.
Yeah, good afternoon, everyone. So I want to believe everybody is for advanced financial management. So this I'm seeing new faces today, and welcome everyone. Welcome everyone. Let's just get started. And I'm trying to drop the question on these teams. I'm finding it difficult. I believe, is everybody on this group? The group page, the WhatsApp group, please, so that you can have the questions. Or Z, can you drop this question for us on on this Teams call? I'm finding it out to drop it. I don't know why.
Don't know if I can.
I've tried. I think maybe we don't have access to that.
Um, if they have access to the WhatsApp group,
Please, if you
I
have
think
access
they
to the
can.
WhatsApp group, please, you can get the question. Okay, but let's move on. Let's move on. So let me share my screen and let us look at the
Okay.
questions together. Yeah.
Okay.
So with us. So
Okay.
let's work with Poplesco and Adipanko. Yeah.
Okay.
So can you see my screen, please?
Yes, we can.
All right. Thank you very much. So this is one of the past questions that was sent to me. I think maybe if not 2014 or so. I can't remember clearly, but this is one of the 25 marks questions that was set in one of the ACCA exams, and it's just a tip. Please, can we mute, please? If you are not speaking, can you mute, please? And is a 25 marks question. Is a 25 marks question. And please, I want you to know that at advanced financial management level, it is not about calculations, right? It's not. In fact, you will notice that when you see some questions, it's usually maybe 40% calculation, 60% evaluation and analysis, more of discussion. So the what I'm trying to let you know is that don't focus your mind on too much calculation, right? Calculation is not the ultimate goal, but calculation is a guide, very necessary and very important, yes, to have your final marks. But calculation is not the main thing at the advanced financial management stage. What they want to see is how you can evaluate issues, how you can profile solutions, how you can advise, because you are going to be talking like a chief financial officer, right? So it's not an chief financial officer level, which is a strategic level. It's not more of operational tactical conversations. So it's how you can advise the board of directors on strategic matters and strategic issues, right? So, like I said, you should be good at calculation, but that should not be your end goal, right? At this stage, is more of what it should be 50% calculation, 50% what analytical and how you can evaluate matters and discussions. So let's go to the requirements here. Can we all see my screen? Can you all see my screen, please?
Yes, you can. We
All
can.
right. So as you like I said, the assumption is that Emmanuel has done justice to merger and acquisition and those the issues on merger and acquisition, and I've also done justice to the theoretical part of business valuation. So let's just solve questions. So we have here the requirement here is estimate the equity value of the combination of Properties Co and Aditan Co. And two, the benefits which would be gained by Public Co shareholders from the acquisition, which is 10 marks, right? The second one is discuss the assumptions made in the calculation, including whether the expected synergies are likely to be achieved. And third one, explain the assumptions which Public Co board can take to ensure that the companies are integrated successfully and synergies realized. So this is the question. This is a typical 25 marks question. How many marks is this? 10, 6, and 4, which is what? Which is 20 marks. And if you notice, it's supposed to be a 25 marks question. So the remaining five mark, where is he hiding? You can see it in the last paragraph. It says professional mark will be awarded for demonstration of skills in analysis and evaluation, skepticism, and commercial acumen in your answer. What's this trying to say? It means that aside from normal marks that you get from your calculation and your discussion, there are marks awarded to what? To evaluation. So how you arrange your answers properly, how you are able to articulate your answers. There's something called skepticism, how you can question the reason why this is and this, that, so you understand. So those things have additional marks that you can get. So at advanced stage, it's not just I just want to write and no, there are some cheap scores you can get if you understand the dynamics of how the question flow is, right? So you can get these 20 marks, but there's a 5 marks that you need to get if you're able to analyze properly, you can evaluate properly, and the skepticism part of it and commercial acumen part of it. So please let note that. Z, please, can you read this question for us? Can you read it for us so that we can start?
I'll just shorten it.
All right.
P and A Co, the following exhibits. Available on the left side of the screen provide information relevant to the question. PCO and ACO, that's number one. Number two, acquisition valuation. So this information should be used to answer the question requirements within your choosing response options. So the exhibit number one, PCO and ACO are two listed publishing companies. A main focus of both companies is publishing magazine, although they also publish a limited numbers of books linked to the magazine. PCO publishes properties and lifestyle magazine. ACO publish magazine covering professional sports. Both companies publish a combination of magazines which have been established in recent years and some of which have been published for much longer. PCO has an in-house team of staff writers and editors who are responsible for content. Most are young and tend to stay for a limited time before moving on to other publishing jobs. ACO have a team of in-house writer and an editor of each magazine, which are specialists in sports, which their magazine covers, and who are in some cases have worked for magazines for many years. Currently, successful sports stars also write for ACO magazine. ACO board have given the managerial and writing teams of the most successful magazine considerable autonomy in determining the content and the development of their magazine. Both companies have an online presence in addition to publishing paper copies of their magazine. Electronic subscribers for both companies can access some content. I don't know where I am. Electronic subscriber for both companies can access some content which is only available online, whereas PCO has won award for its online presence and in-marketing. ACO website has been criticized for looking old-fashioned, with the main appeal of its online offering being the high quality of its writing of the content which is only available online. PCO is planning to make a takeover bid for ACO. So in this case, P is the acquirer, A is the target.
Yes.
So if you can just note down, and has contacted ACO board. PCO board believes that the acquisition could provide synergies, particularly in terms of online presence, marketing and cross-selling, and also savings in staff, administration, and paperwork costs. So Exhibit 2, acquisition value, valuation. The current market value of PCO equity is $620 million, and of ACO equity is $340 million. ACO board has indicated that its shareholders will expect a premium of 20% above its current equity value. That's 1.2 over 340 USD. Then PCO board feels its shareholders will also expect again at least 20% of its current equity value of their shares from the acquisition. So both A and P are expecting 20% equity premium, kind of. So PCO wishes to estimate the equity value of this acquisition with the free cash flow to firm method using the information, the following information. Expected sales revenue in the first year when the company are combined of is 720, in bracket, the sum of sales revenue of two companies for the most recent financial years, and an expected sales growth in each of year 2 to 4 is 8%. Expected post-tax operating cash flow in each of year 1 to 4 is, I don't understand this, of 14%. Okay, is 14% of the sales revenue. The company requires additional investment in non-current assets of 25 million in year 1 and 0.3 USD for every $1 increase in sales revenue in each year 2 to 4. So after year 4, an expected annual growth rate of the company free cash flow to firm is 4% for the foreseeable future. Assume a cost of capital of 10%. The target debt to equity ratio of the combined company is 1 to 3.
Thank you very much.
So requirements.
Okay, I think we've read the requirement, right?
Okay.
Yeah, we've read the requirement. Thank you very much. So do you understand the question? Let me start with that.
Yeah,
How
it
many of
makes
us?
sense.
Yeah, so this is what you'll be expecting to see in the exam on a norm. So let's start. So if we notice from your knowledge of merger and acquisition, did you touch the part of synergy?
Yeah, we did.
Okay, so what do you understand by synergy? Let's start with that.
I think additional gains as a result of both companies merging, coming together. Those additional, like economic of scale, scope, duplication of administrative works and all that you can get from the acquirer.
Thank you very much. So that's basically synergy. So it means that if me as a company, Adeyemi Limited and Z Limited, if we are coming together, right, the synergy, what we are expecting to see is that if both of us combine together, the output is supposed to be more than if both of us are working individually, right? So,
Yes.
and working combined together, there are some costs that we might eliminate, like one, premises cost, right? Instead of me renting an apartment and you renting an apartment, by the time we're combining, we'll just use one apartment, right? Also, in terms of staffing, I have so number of staff, you have so number of staff. By the time we are going to merge, we might not require so much staff, right, to work for us. So those are part of what? Those are costs that can be reduced drastically to achieve a greater output. So we can see here that in this Publico and P and A, you will see that they have different, how will I put it? They both have individual strengths, right? You see in Publisco in-house team writers and editors who are responsible for content, you will notice that they are young and they tend to stay for a limited time before moving on to other publishing job. But for Aditanko, is in-house writers are usually specialists. They are specialists in sports, which their magazine covers. Let me read that. Aditanko has a team of in-house writers and editors for each magazine who are specialists in the sports which their magazines cover, and who in some cases have worked for the magazine for many years. So if you look at it, you will notice that Aditanko, right? Its managerial skills focus on a way that its staff tend to stay. They are loyal to the company. Did you notice that? And also for Publisco, they are young. They don't stay long. They within 1 year, within 2 years. And on a norm, a company should not be like that. People should be able to, even as much as it's good to move from a company perspective, you should expect that your employees should be loyal to you and they should stay at what longer periods with you. But it might be some managerial issues that might cause you not to have those stable kind of employees. Maybe the way you treat them or the way you manage them. So those are kind of integration issues that might happen when they are merging together that they might need to look into. So you also see where they say Adidas Co website has been criticized for looking old fashioned, right? Whereas for Public School, I think they won our award. If I remember the question correctly, they won an award. They are good. Their online presence is very strong, and so on and so forth. So, but for Adidas Co, is old fashioned. So you can see some cultural issues that might happen if they begin to merge. Because why? They need themselves, right? But also there are going to be some issues because why? They may have to take a compromise in which strategy they are following. Okay, are we going to be straight? Are we going to go in this line? Are we going to go in so line because of their individual differences? So those are things that will happen alongside when they are trying to merge. Also, they will look at where they are strong. Like for instance, now if Vatican Co is old fashioned. By the time they are merging, it will leverage on popular skills, which is kind of current and kind of strong on online presence. So they might want to adopt public school approach to marketing and sales process and so on and so forth. So let's solve questions. So we have it here. What have they told us to do? They said one, the equity value of the combination of public school and Danco. If you notice in this question, they said in exhibit 2, that's where you have the numerical issues to work on. So you will see here, they said the current market value of public school equity is 620. So they've given us for public school and they've given us for Danco. But we don't have the combined value equity, right? We don't have the combined value, the combined equity value of both of them. So what do we need to do? We need to solve the combined equity value of both companies. So, and how do we solve this? Can anybody assist me? What methodology do we use in solving this? Based on the information provided, what are we going to use, please?
I think
Hello?
free cash flow. The question said free cash flow to firm.
So thank you very much. So we're going to be using the free cash flow to firm approach. So let's start with that. Let me make my screen this way. So we're going to be using Excel. Like you all know, you're going to be making use of Excel in the exam, so we just make use of Excel straight. So let me know if you can see if this is okay by you. I don't want this. I want the question. All right. So I'll show my system. All right, let's work. I don't know if system is acting up. I'm trying to split the question. All right, so I think it's fine now. So you can see both screen, right?
Yes, we can.
All right. So let's start with the free cash flow to firm. So these are you start normally in an exam setting. So one, let me just copy this straight from here. So this is title on your Excel. So you have a purpose code and add the term code. What are we to solve? Well, expected to use the free cash flow, the equity value of the combination of purpose code and add the term code. So we have free cash flow. Yes. So, and they said for this thing, from what they gave us, they said expected sales revenue in the first year when the company are combined is what? Is 720. That's the first year. The sum of the sales revenue of the two companies for the most recent financial years, that's in bracket. And an expected sales growth in each of year 2 to 4, meaning that is year 1 to 4 we are working with, since they gave us they're giving us the range of years, year 1 to year 4. So if I were you just come here for free cash flow to firm. What do? We always have year 0, which is the now, year 1, year 2. So we can drag this to year 4, right? So what do? We come here. They've told us about the sales revenue. Sales revenue is what? Is 720. It's expected you put in your dollar rate here. Your dollar rate, dollar is in what? Is in million. So you have it like this. So sales revenue is what? 720 in the first year, based on the combined equity value of the combined company. So expected sales revenue in the first year when the companies are combined is 720. So 720, we have it here. So they now said an unexpected sales growth in each of year 2 to year 4 is what? Is 8%. So if it's 8%, what do? You just come like this. 1 plus what? 8 what? 8%, right? Or better still, if you want to make your work look more neat and this thing, depending on time, you can just put your 8% here, right? Let this be here, and you come to this side. Let this one lock this guy, right? So you have it like that. So it's expected to grow, right, for the foreseeable future. So come here. This guy is it clear?
Yes.
All right. So let's move on. So what's the next thing? After sales, what did they give us?
Post-tax operating cash flow.
So they gave us the operating cash flow. So they didn't. So even notice in this question, they didn't stress themselves. There's nothing like variable costs, fixed costs, all those things, and blah blah blah. So this one is they're not interested in that in this question. That's not the target, right? So we move on. So post-tax. But we all know how to get the post-tax operating cash flow if you have a full-fledged question, right? Is the normal free cash flow to firm we've always known, where you have your variable cost and tax and all those things, fixed cost and every other thing that will make you arrive at your post-tax operating cash flow. But yeah, they've told us that the post-tax operating cash flow is what? They said the expected post-tax operating cash flow in each of the year 1 to year 4 is what? Is 14% of the sales revenue. So we just go straight, 14%. You can have it here too also, 14%, right? This multiplied by this, right? You can log this cell. So, and you drag. So that's all about that. Let me make this. Yeah. So this is it. So when you have this is the main guy that we need actually. We've gotten the post-tax, so I can bold this. So we move on. What's the next thing? The next thing is you get your addition. They said here, the company requires additional investment in non-current what? in non-current assets of 25 million in year one, and 0.30 for every $1 increase in sales revenue in what? In each of year 2 to year 4. How do we do that, Z? Can you interpret this? Can you guide me?
Which one, sorry?
This guy, the company requires additional investments in non-current assets.
Oh, okay. The first year is minus 25.
Okay, minus 25.
The second year will be the difference between year 2 and year 1 sales
Okay.
times times minus 0.3.
Okay. So thank you very much. So times 0.3.
Minus 0.3.
Yeah. Right. Thank you very
First
much.
one
So
is
yes.
the first one is minus 25.
Yeah, yeah. So depending on how you want to present it, is when you are summing, whichever way on the Excel, right? You can leave it on minus, you can leave it on absolute. The main goal is when you're adding up, you know what you're doing. Do you understand?
Yes.
Yeah. So we can drag this. So with this guy, we have the what? We have the free cash flows, right? So that's that about that. What's the next thing? They said for the foreseeable. Okay, so we have here that after year 4, an expected annual growth rate of the company free cash flow to firm of what? Of 4% for the foreseeable future. Assume a cost of capital of what? Of 10%. In what do we call this thing? Z, this next step, what do we call it? What are you trying to get?
So like year 5 to infinity, right?
Yeah, what's it called not normally in finance?
Perpetuity cash flow.
It's called terminal value.
Okay,
Yeah. So let's do that. So we have it. So from year 4, you start from year 4, right? Year 4 multiplied by what? 1 plus. They said 4%, right? 4%
yes.
divided by what?
It's a capital. That's 10% minus 4%.
Thank you. So 10% minus 4%. We have this. So this is the terminal value, right? From year what? Year 5 to perpetuity. So we come here. When you have your free cash flow, what do you have? You have your cost of what? Your cost of capital. Cost of capital is what? What's the rate?
10%.
So 10%. So it means that I have to get normal present value will be 1 plus this, right?
Yes. Let's do power
Raised to the power what?
minus 1.
Thank you. So we can also have it this way for this guy. It's better you even start from year 0.
Yeah, 0, yes.
Yes, that's the best thing. So when you're under exam condition. So it will be C, 1 plus C. We can lock C and leave it this way, and we drag. So we have it this way. Yeah. So don't forget that, when you're getting the present value of year 5 to infinity, is year 4's present value discounting factor you're going to be using. Hope we still remember that.
Yes.
Yeah. All right. So we move on. So when you get your cost of capital, you get the present value. So your present value will be what? Well, let's start from year 0. This multiplied by this. We have this. So so now Now we have the present value. Now the estimated value of the combined company will be the addition of all the future cash flows up to terminal value. Please, do we all understand this part? Any question, please? Are we all here? Z, are you there?
Yeah, I'm here.
So I was asking any question, please, from anyone. Are we all clear? Are you clear on this?
Yes, I am.
Okay, now if we have the estimated value of the combined company, when you are doing valuation, right? Don't forget that this approach we use is the free cash flow to firm, right?
Yes.
If it's the free cash flow to firm, it means that it is not only equity, it's not only equity value that is involved here. We also have debt value. Am I following?
Yes, yeah.
Thank you. So it means that if I want to strip out the equity value, I need to know the equity portion, right?
Yes.
And from the question, they already told us that the target debt to equity ratio of the company is 1:3, right? So if debt to equity ratio is 1:3, which is also 1 divided by 3, normal setting, it means that debt will be what? Debt will be what? 1 divided by 3, right? Multiplied by what? Multiplied by this.
Yes.
So if my debt is this, it means that equity is what? Equity value is what?
3/4.
3/4. Thank you. So 3 divided by 4. Oh, I used 1/3 here. Yeah. It's supposed to be 3/4. So this is equity value. Debt is meant to be 1/4. So it means that 1 to 4, 3 to 4. So that's it. So this is for debt. So if this is the case, then we move on. So what do we do next? Now, they are telling us to calculate the equity value of the combination. So this is the equity value. This is the equity value of the combination. It is the equity value of the combination. The next step is what? The benefits which will be gained by public co-shareholders from the acquisition. Z, what do you understand by that? How do we do that? How do you think we need to go about that?
The what? Additional benefits.
They said the benefits which will be gained by public co-shareholders from the acquisition.
You get the combined equity.
Yes, which I've done.
Then you deduct the market value of the P&A.
Okay. So thank you very much. So that's how we go about it. So that's what we call synergy, right? Synergy is the benefit.
Yes.
So for synergy benefits, what do? We do the estimated equity value. Z, have you solved this question before? You've approached it before, right?
This is my first time of saying it. Just
Okay.
that I've done something similar.
Okay, nice. So multiply by the market value.
I have a question. Okay, don't worry.
Okay, you can ask your question, please.
My question was I initially thought that you are deducting from the market value of the firm. I just went back to the question. I saw market value of equity for P. I thought it was the firm, but
no, it's not firm. It's not firm they give us. It's
It's
equity they
equity.
give
I
us.
just saw
Yes.
it.
Yes. Most times it's usually equity they will give you, right?
Can
It's
you
mostly
advise?
okay.
Is it 2 decimal places, or we can just round off
No, you can round off. You can round off. There's
in
no
in
difference.
in exam case? Because most of the
Yes.
time the answers, okay.
You can round off. You can leave it at 2 decimal place. Whichever one, anyone works for you is fine, right?
Okay.
Anyone, you get your 100% mark. It doesn't matter. So we now move on. So this is synergy benefits. What the combination of both less what individual what equity value. So the estimated the estimated value of the combined company is what here? We already have it here. Is
1167.
please estimated equity. Be very careful. It's not value. Equity value. Very, very key. Equity value. We now have the market value of what? Of properly score. You know, on that exam question, you might not go through this approach I'm using. You might be very fast. You know, you're working with time. The reason why I'm breaking it down this way so that even in the future, whoever is watching this video can have a what step-by-step process of it, of how we go about it. When the exam, or you might be fast, you might not need to go through all this long process that I'm going. Yeah, so the market value of property school, they gave us in the question now. They said is what? 620, right?
Yes.
So we have 620. What about for the other guy? The other guy is what?
340.
340, thank you. So 340. Make this guy this in dollars. Yeah. So what's the synergy benefits? Synergy benefits is this. This guy minus sum of this guy. This is the synergy benefit. So this is the synergy benefit you have from what? From the what? From the merger of what? An acquisition. So then we move to what? Now, in the question, they said in that exhibit 2, you will notice something. They said the benefits which will be gained. This is the question. The benefits which will be gained by public school shareholders from the what? From the acquisition. You know, this synergy benefit is what will be gained by both of them, right?
Yes.
So they're now asking us that the benefits which will be gained by public school shareholders. That's the question. So if we will now go back to the question. It says here that the current market value of public equity is 620 and A is 340. A board has indicated that its shareholder will expect a premium of what? Of 20% above its current equity value. And P board feels that its shareholders will also expect a gain of at least 20% of the current equity value of their shares from the acquisition. What do we now need to do?
We got 20% off.
So A, yeah, thank you. A has said its shareholders we expect
20%.
20%. So we go to A, add the tanko. Let me just use A straight. A is eco share benefit. The 20% multiplied by this. Let's read it again. Add the tanko. Where is it? Adican has indicated that shareholders will expect a premium of 20% above its current equity value. Do you know that this is wrong? Z. Everyone, can you hear me, please?
Yes, 20%
above its current equity value, meaning that what's the expected premium that Adican board is expecting? 20% of what?
Of their equity. That's those three. Is it I'm seeing PP instead of AP.
It's because we copied. That's the problem when you copy and paste directly. So what's A equity value?
340.
Thank you. But none of you corrected me now. You allowed me cook the beans. Eh? Thank God I had to read the question again. They said, Adidas Co board has said that its shareholders will expect a premium of 20% above its current equity value, not 20% of the synergy benefit. Please don't make that error. So 20%, so it's 20% of what? C what? C22. Meaning that this is the what? This is the expected minimum they're expecting, right? This is what they're expecting. They are settling for this. What they just want is 20% of what? Of whatever their current equity value is, which is what? Which is their equity value is 340. They expect 20%. This is what they expect. So it means that if they expect 20%, right, and this is what we are giving them, who owns the remaining one?
P.
P. So that means the balance will go to P. The balance will what? Will go to P. So the difference is what? Okay, your question, please.
You said something like expected minimum. There are cases where questions can ask expected minimum. What about if they now ask maximum expected?
If they ask you maximum is 20 here in this question. For A, the maximum is 20.
No, you said it's either premium expected from A or expected minimum amount from A. I said in cases where they ask you what is the expected maximum amount, what are we going to do?
When they give you expected maximum account, it means that when we say expected maximum amount, it means that this is the expected premium the person is expecting. That's the when nobody will ask you an expected maximum amount, first of all.
So okay, all right.
Yeah, nobody will ask you. Who wants to? That's a loss on whoever is investing now. The worst case will happen is this is the minimum I'm expecting, or this is what I am expecting. Do you understand?
Okay.
Do you understand? If you notice the two questions, you will see it here. Adidas Co board has expected that its shareholders will expect a premium of this is what they want, right? We want a premium of 20%. Do you understand? They've told you this is what they want. Now, if you notice Properties Co said in after the next sentence, Properties Co P board feels that its shareholders will also expect a gain of at least. Do you understand? So Properties Co is saying that okay, the minimum we want is 20%. We want more, but the minimum. Do you understand? A is saying that this is what I want. I want 20%. So the person that wants 20%, let's even first settle that person first. That's why we have to settle the person first, which is this. I want 20. We've given him 20. If he wants 20, it means that the remaining out of this 207 will go to what? We go to P. Now, P is 139. But P has also given us a condition, right? What does P say? P say he wants at least 20%, right? So for us to know if we're able to meet that target, what do? We express it in what? In percentage. So expressed in percentage. And expressing it in percentage is just what? This 139, which goes to P, divided by its own current market value, right? Which is 620, which is what? 22. Now the question is, did we meet both of them's targets? Yes. So we met both of them's targets. It means that A wants 20%, we've given him. He said the minimum he wants is 20. We're able to achieve it from the synergy benefit. It means that is the expected measure, is it worth Y from numbers perspective? I'm throwing it to everybody.
Yes, it does.
So you can just put a small note there for them and say the investment is worth Y. This fulfill what? Everybody, all stakeholder what? Requirements. You don't need to talk too much. At this level, don't speak. You're not talking too much. You know you're working with time. So you don't have to put long sentence because you love the question. You know, sometimes people are usually missing. When you love a question and you understand the question, you now start writing too much. Please, just go straight to the point. The examiner doesn't care about the story you write. Is is more of what how you can hit the main point immediately. So if I were you, I'd just say, okay, um, A expected the premium of 20%. It was achieved as seen above in the calculation in the your this thing is like an exhibit was seen above in the calculation, which it will be able to achieve what the 20%, which is $68. Whereas the balance which is remaining of 139, which expressed as percentage is 22.49, will also meet what the requirement of what P board of directors as they expect what a minimum gain of what of 20%. That settles it. Are we fine, please?
Yes, we are.
All right. So let's move on. Let's move on to the next question. Like I said, when you solve question and you solve calculation, it does
So,
not end there.
please,
Okay.
please let me see this thing up.
Okay.
The free cash flow.
This is the free cash flow. Let me make it white so that you can see clearly.
Okay.
So this is it.
Okay.
I'm going to share this with us at the end of the class. Let me do 2 decimal places. All right. Do you still need? Are you fine?
Sorry, I'm just looking at it. It's
Okay.
okay. If every other person is okay, it's fine. You can go.
No, please. Every other person who, let me see who is on the call. Otonga and Ostino, are you there, please? Okay.
Yes, sir.
I'm not here. Okay. Should we?
Yes,
Are
sir.
you fine? Are you fine with this? Do you have any question so that we can move on?
I would have had, but I'm in the office still working. I used to go to work on Saturday too.
Oh, apologies. I was once like that.
That full concentration is not really there today.
Oh, so as long we're recording, right? So you can just watch the recording.
His account is in account department that I am to also, so it's easy.
Well done. Well done.
Mm.
All right, so let's move on. At least the main thing is that there's recording, so you can always watch it after when you're free.
So how do you
lock
a cell? Is it the dollar sign?
You can use the dollar sign, but you can use function F4, F function and F4 to lock.
Because I'm trying to do it, it's quite hard.
No, use FN. Can you see FN down beside control?
Yes.
FN, press your hand on the FN and function 4 up. Let's see if it will work for you. Those systems are different, but check that first. Did it work for you? Z.
Hello?
Hello? Did it work for you?
I clicked that thing and I just went off the meeting immediately.
Oh, are you back now?
Yes, I'm back now.
Were you able to do it with, did it work? The lock sign.
I don't know how you did it.
So this is it.
So
let's say I have
one plus, then dollar sign, capital letter C, right?
No, me, I didn't use dollar sign. No. I use function and F4.
Function and F4. Okay.
Function and F4. FN, the FN that is down beside control, and F4 that is up. That's what I use. This is it.
It's not coming.
It's not going for you.
It's not going for me.
Don't worry, that one we'll do that one later. Don't let that one.
Okay.
Don't worry. Me and you, we can go on private to clear that. All right, so let's move on so that we won't waste time. All right, so now the second question. You can start with all the calculation that we've done. You will notice that it's just how many marks? How many marks, please? The calculation part is just what?
think 10 marks.
It's just 10 marks. So you can see that it's not about calculation. So don't go and focus too much and you think that it's all about calculation, soft calculation without having understanding of the question and the evaluation part of it. Calculation will only give you 50%, like I said earlier. So you can see that out of 20 marks, calculation is 10 marks. Now, they're not telling us what in B, they said discuss the assumption made in the calculation, right? Including whether the expected synergy are likely to be achieved. So what were the assumptions made that we need to discuss, please?
There's a lot of assumptions.
Thank you very much. Example, just tell me one.
How did they get the cost of capital of 10%?
Thank you very much. So those are things you will put when they're telling to discuss. You can say, okay, the work of 10%. In the question, they said, assume a cost of capital of what? Of 10%. Was it rightly calculated? How did they achieve that? And also, are you saying when we combine the company, right? Are you saying they are going to be using the same capital structure? Those are the things the examiner wants to hear from cost of capital perspective. If we combine now, is the capital structure going to be the same? Let's say before, individually, we are using 40% equity, 60% debt. Or maybe the second company is using 60% debt, 40% equity. By the time we're combining, how is the mix going to be? Is the capital structure not going to change? If you're not telling us to assume, those are things that we need to question, right? That's professional skepticism. The cost structure, is it going to be the same? Also, the business risk and the finance risk, are they totally operating in the same industry? And are we saying the business risk is not going to change? If the business risk is going to change, definitely the cost of capital is going to change. Do you understand? So those are the things you are going to talk about. You are just going to talk about the small. Those two sentences is okay for that. If you eat capital structure and also the business risk and finance risk, the examiner will know that you know what you are saying. Don't speak too much grammar. Just go straight to the point. One sentence, 2 lines is okay. You are done with that. Another thing, thank you for bringing out the cost of capital. Another thing again is, what are we going to look at? We're going to look at the sales growth. They said the sales growth is going to be how many? 8%. Is that visible? Are you saying it's going to be constant for 8% across the whole years? Are there not going to be shocks? Are there not going to be economic issues? Are there not going to be, you understand what I'm saying? So are we saying 8% is not realistic? So those are things you are going to question. Also, they told us what the operating cash flow from year 1 to year 4 is going to be 40% of sales revenue. Are we saying the variable cost is going to be fixed across line? Because, do you understand?
Yeah.
Variable cost is going to change. Fixed cost is going to change over time and all those things. So are we saying, so those are things you are going to question. That is what they are just saying. That's what they are just telling you to discuss in this part, right? Also, we talked about the 4% constant growth rate in perpetuity. Is that visible? Can 4% can we have a 4% constant growth rate to perpetuity? That is not realistic. It's unrealistic. So those are the points you are going to put for them. Just put like 5 points for them, right? As we've discussed. 1, cost of capital. 2, constant growth rate of 4%. 3, 40% operating cash flow. 40% of sales revenue, operating cash flow. Sales growth 2 of 8%. That's how many? I've mentioned 4 or 5 now. Just talk about that. Two sentence on each. Move on. Are we fine? Can we move on?
So you said 4% constant growth rate, COC and variable cost, that's 14%. Which other thing?
Okay, let me just sort of. I talked about one. I said sales growth. Sales growth of what? Of 8%, right?
8%. Yes.
2, you're going to talk about that. You're going to talk about operating profit margin. Profit margin. They said it's going to be 14% across, right?
Yes.
You're going to talk about that. It's not realistic. You're going to because if you are saying operating profit is going to be 14%, Are you saying variable cost too is going to be constant? Are you saying tax is going to be constant? All those things that are in between. Are you saying this thing is going to be constant? Fees cost. Those things will never be constant. So you cannot have an operating profit margin of 14% for the 4 years. It's not real. So theory, WACC. They said the WACC is what? WACC of 10%. And I told you what to say about WACC. This is what the person wants to hear. Business risk, finance risk, finance risk. What again? I talked about. I said one more thing. Remind me. I want to see if you are following.
That was why I asked you because I didn't get it.
Oh, okay. I talked about capital structure. That's what the examiner wants to hear in your work, in your cost of capital. So the fourth one, I talked about which one did I say again? No, there's one again that is the annual growth rate. Annual growth rate of 4% into the foreseeable future is not realistic. You talk about that, right? Because there can be what economic shocks in the country and all those things. So you can't expect an annual growth rate of 4%. All right, so I think 4 is okay now. 4 is okay. Another thing again you can talk about, right? How many marks are they even giving? It's depending on the mark. That's what you know what you're saying. Discuss the assumption made in the calculation whether, okay, 6 marks. If it's 6 marks, that means it's good to have like 5 points. Abi?
Yes.
5 or 6 points. So 5, what again can we say? We can say this. You can say, normally, when you are doing valuation, right? When you are doing valuation, if you don't carry out proper due diligence in valuation, you end up, and if you have done estimate and you're thinking, oh, this is what you're going to get, you'll just be shocked that there are some hidden costs that you do not bargain for that you'll be seeing in the long run. Are you following?
Yes.
For instance,
Like,
now they can, okay,
like
talk.
those
Thank you.
I think those agency costs.
Thank you very much.
Valuation cost,
Thank you very much. There are some hidden costs that you end up incurring. So another thing you can say is that proper due diligence. It is assumed that proper due diligence have been carried out. Meaning, we are not expected to see unravel hidden costs. Hidden costs that we did not bargain for. Not estimated. Do you understand?
Mm-hmm.
You have another point so that we can make it 6. I think 5 is okay. You can, in your personal study, you can think of another one. I've tried. I've given you 5.
It's okay.
So you're gonna look for the last one. All right. So let's move on. Next question. They said, explain the assumption which board can take to ensure that the companies are integrated successfully, and what the synergy that we are expecting. We've assumed that we are going to get the synergy of 207, right? What do we need to do to achieve this? It's not by mouth say, it's not by numbers, by what? By real action. In real life, it's not about numbers. It's about what? The strategies that we need to put in place to achieve these numbers. So from your understanding of merger and acquisition, and I believe Professor Emmanuel has done a great job on that, what do you think we need to put in place to achieve this synergy as we have proposed and we've projected? Thank you very much. I need you to speak.
How much are you going to give me?
How much am I going to give you?
Mm.
I'm going to refund you 5% of your fee.
All right. I'll say first of all, try and ensure like you said, proper due diligence are carried out to avoid kind of overvaluation of this business. Then you ensure that there are lesser or reduced conflicts between when in case of integration, you ensure there is lesser conflicts, and you ensure that both culture of the business are properly integrated. And I can see from the case that is they have online presence, so tech is not an issue. They have good economic of scope and scale. So it's not just that you have issues between one of your key assets, which is employees. You want to make sure that both of them are there to work together so that they can expand. The expansion of the market power will be there. And one more thing is an integration issue. You try as much as possible to ensure the integration between both companies works well. And at the end of the day, then you can also do post audits, like violation audits at the end of the day, just to have that peace of mind. Can I get my 5% back?
You're not only going to get 5%, you're going to get 25%. Because you've done justice to it. And this is what we are expected to discuss. So we are looking at it from an angle of integration issues that can happen, right? And how we can manage integration issues in a company. And even aside from book knowledge, I've had the opportunity of working in a company whereby we've done merger and acquisition twice, right? And we had to integrate with these companies. For instance, now I work in Access Bank, right? I work in Access Bank, and I know you know Access Bank very well, right?
Yes, I do.
I don't know if you would have done all this because I know you worked in an audit firm. I don't know if you said which audit firm did you work with? Did you work in initially? I want to know if you guys had done an audit firm on our company.
What we normally audit is those shell companies, NIPCO and the like.
Oh, okay. You don't do normal audit
No,
on FS.
No, we don't do bank audit. It's
Okay.
oil industry. In the oil industry.
Okay. That's where you okay. So I've been in a situation whereby in Access Bank, if you notice, if you've been following Access Bank, we are very big on merger and acquisition, right?
Yes.
We're very big if you've been following online and all those things. We're very big on merger and acquisition. In Nigeria alone, when the bank acquired, we acquired Intercontinental in 2009, if I'm not mistaken. We also, which other company do you know we acquired from in Nigeria? Which Nigerian bank did you know?
I know Access Bank. Access Bank, what they are always looking for is one bank that has problem and they go and buy that bank. And I don't know why they do.
I don't know what you're talking about. I'm not in that conversation with you. The only thing I can tell you is that we acquired Diamond Bank. We merged with Diamond Bank. Let me put it that way.
That's what you guys do. That's what you guys do. You always find companies.
Auntie, that is not the conversation. Please. I won't sit down here and you come and talk about my institution. The only thing I can tell you is that we have done a good job and we are one of the best in merger and acquisition in the company. Everybody learns from us. Okay. And we've grown significantly as a result of our strong insights on mergers and acquisition issues. So let's move on, and you should give us our flower, by the way. Okay, if you notice in the C part, like I said, what are the issues that we can face in integration? Let me give you a practical example. We, for instance, in Access Bank, right, between me and you and whoever is listening, they normally call us access warriors. We were trained to be to be rugged. For instance, we can work from 6 a.m. to 11 p.m. Monday to Sunday without getting tired, right? Let's say we are acquiring another company whereby in their own place, their life is very is stress-free. They don't like stress. 8 to 4, they are done, they are leaving. Do you understand? And you now have a company that is acquiring you that they can work 6 a.m. to 11 p.m. Monday to Sunday, and you Saturday and Sunday you don't even work. Even if you now come to work Saturday and Sunday, the company must compensate you for for feeding allowance, for transport allowance. So even if you are coming on a weekend, they are going to give you something for happy moments or for taking your time. Because why? You are of the opinion that time is money, time is value. But you have a company whereby, for instance, a company, they don't believe in that. We own you people. You work from what? You work for us. Whether we call you on Saturday and Sunday, we don't care. Just come and what? Just come and deliver. Are we following?
Yeah.
So by the time they are coming together, are you telling me that the company B would find it funny to be integrated in company A?
It will be hard.
No, it's going to be hard because those one will come and say, are you people what? Are you people slaves? Where we are coming from, we don't work morning till night. Oh. We only work 8 to 4. We are done. Saturday and Sunday, even if we are coming what? We are coming what? They are going to pay us for that. But in your own place, because you are what? You've acquired us, we don't have a choice. Yes, we have to work for you. But we have these issues. We cannot deal with this. We don't come Saturday and Sunday. We all have our personal life. There's something we call what? Work-life what? Work-life balance. Please, I have a life to live. I cannot deal with this. You cannot deal with this. You know, we can have it in a way that those people that cannot deal with this are now the people we even need, which are the key personnel in that company B that will support our processes. Am I wrong?
Yes.
So what do we need to do? First of all, identification of key personnel to retain. When we identify key personnel to retain, what do we need to do from both ends, either from A, either from B? What do we now need to do? We now need to find a way to what? To package remuneration for them in a way that it will what? It will be acceptable, and also we need to what? Revisit our what? Our culture.
Okay.
And you made mention of that when you were talking culture. So if we in company A, we usually work morning till midnight, since we are bringing people in and we need their expertise, we need to what? We need to what? Either manage our culture properly or revisit our culture and what? Reach a what? A compromise. So I've said 2 points now in this sentence. Identification of what? Of key personnel, and also what? And culture what? Culture management. Is that clear?
What about the owners of the business?
Okay.
That's the shareholders.
What happened to them?
How do you make them happy? Because you need to, first of all, increase their wealth, which is like the key essence of a financial management, a financial manager. And
Yes.
quite already, they are the owner of the business.
Yes.
If you're explaining these cases now, how do you integrate the shareholders' needs here? Because we're only boiling down on the internal factors, like the internal stakeholders, rather, the employee, employer, the whole system operational. What about the stakeholders, the shareholders, the institutional investors, and every
Thank you
other
very much.
person?
Thank you very much. Thank you very much for that beautiful question. But if you will notice, right, before we go to even internal, if you've been following, you will notice that we've tried to cater for what? For the shareholders, first of all. And how did we cater? Ask me why. One of the reasons how we were able to cater for the shareholders is that the shareholders have told us that for this integration to be successful, or for us to achieve this integration, or for we to even say we are acquiring, we are expecting something. A has told us that he's expecting 20%. A shareholders above his what? His current value. B has told us that he's expecting minimum of 20% above its own current value. From our numerical estimates, were we able to achieve that? I'm asking a question.
Yes, we are.
We've catered for them already. We've told them that if we do this synergy, this is what you are going to get. This is what you are going to get. A shareholder has seen that is going to get 20% for A. P has seen that is going to get not only 20% minimum, is going to get what? 22.49. It's already fine. Any headaches that you put, how you now want to achieve it? That's you people's business. Are we following?
Yes, we are.
And who is going to achieve that? Shareholders have told you what they want. The remaining work is on who now?
The management.
Thank you very much. Agency management.
And yeah.
Yes. Agency theory. Board of directors and who? and the shareholders. Now, it's the board of directors that now have this headache of all these things we are talking about, of all these internal issues that need to be addressed. Because if they don't address these issues, they cannot achieve those numbers that they've told shareholders. Are we fine?
Yes, we are.
Does that answer your question?
Yeah, it does.
Thank you very much. So we talked about what? Better conflict management, like you said. We talked about identification of key personnel to retain and how to manage them properly. We talked about cultural issues that might come up in the event of the integration, and how they need to reach a compromise. We're now going to talk about also communication. Communication is very key in integration process. I'm a practical example. That's why I can tell you. Because why? When issues like merger and acquisition start coming up, what happens to the staff? Staff start getting afraid that this one that they want to acquire, they might want to sack some of us. Do you understand?
Yes.
They might want to sack some of us. So when they want to sack some of us, you start seeing panic. Also panic, not only panic, you start seeing some people, let's say for instance, bank. Some people, they want to sack me. What do I need to do? Let me steal the money I can steal on time and run away. Fraud, likelihood of fraud will start going up. Are you getting me?
Yes.
Because why? Some people will start thinking, they want to sack me. So what do I need to do? Let me quickly do let me conduct a fraud exercise and cash out and run away before I'm being caught. So we all need to be very careful to reduce those potential negative issues. There need to be proper communication, consistent assurance that you guys we are not planning to sack you guys. What we need to do, we are acquiring, yes, we are trying to absorb everybody as much as possible. The only thing we just need to expect from you as a staff is that cooperate and do your job properly. In the event you don't do your job, that's when we might be considering laying you off. But when you do your job and you do it in the proper way, there is no issue. So that communication needs to exist at every point in time to ensure that there is no undue pressure or panic. So communication is very, very key to minimize staff turnover. Is that clear?
Yes, it is.
Yeah. And also the last thing I will talk about is IT. The IT systems need to be reviewed properly to understand if there are barriers in the way of integration. When we talk about IT issues, we're coming from, let's say for instance, because I work in the banking industry, so I can use banking as a good example. Let's say for instance now, Access want to acquire GT. Access is using a particular core banking system, which is FlexCube. Let's say for instance, GT is using a core banking system which is not called FlexCube, which is maybe called Pinnacle, right? I don't know. I know you'd have heard of something like that before, if at all. So let's say for instance, Access Bank is using FlexCube, GT is using Pinnacle. By the time we are integrating, it's going to be a big problem because the systems are totally different, right? Okay. So integrating both systems will need to sit down properly and manage it. It's serious work when you are doing all those database management, blah blah blah, and all those things. If you are 90, I'm not a 90 person, right? So when they are doing all those things, there can be issues that can come out of it. Also virus, also attack, because at that point systems are vulnerable, right? So attack from external parties or anything, viruses and all those things need to be curtailed properly. So IT needs to be reviewed to understand if there are barriers in the way of integration and proper management. So I think I've measured 5 points. Are we fine?
Yes, it's fine.
Thank you very much. And see, knowledge of what I've just told you, any merger and acquisition question, you are going to use it. It's no more than this. Any merger and acquisition that has to do with what are the integration issues that need to be addressed and blah, blah, blah. This is just how you center your answers. It's not far from this.
Okay,
yeah.
Thanks.
So I believe we've been able to do justice to this question. Any question on this question before we move to the next question?
No, it's fine. Everything's fine.
All right, so let's move to another question, another variant of merger and acquisition. I'm intentionally giving you this kind of question. This is 25 marks question. We're going to do like 2 25 marks questions today, right? So that by the time we are meeting, we are doing a full-fledged 50 marks question.
Okay.
Deep knowledge of 20.
Don't forget our investment appraisal. That will be cool.
Don't worry. We're going to do. Don't worry, Z, I'm fully back. Don't worry, I'm fully back. Don't worry. I know you have concerns about me. Don't worry, I'm fully back. I know that one, and I can't blame you because why? Like I told you, I was very busy that period. I was running a program and I didn't have that time at all. I just had to start so that we won't delay. So, but I'm fully back. Don't worry, we'll cover everything. Like I said, I told you Wednesday. Fix me up for Wednesday. We are going to continue again. We are going to solve more questions. I'm going to be doing. I don't know Emmanuel's schedule, right? But just know that we are going to be doing Saturday and during the week for you. Saturday and during the week. At least solve 2 questions during the week. Do you understand? With that, we are
Right,
going to
thank
cover.
you.
Don't worry. Yeah.
Thanks.
So let's move to the next question. I think I sent that too to the group.
Mm.
So you
Okay.
can open that one.
Please, where are the rest of the class?
I should be asking you people. The other guy said he said he's in the office, so he's not fully. Osino, I'm not even hearing Osino's voice at all. So I don't know. Osino, are you there with us, or because you're not asking questions or the likes? But I want to believe you're following and you watch the video. So at least the good part is that the video is on record. So Z, let's move on to Celon. Have you opened the Celon?
Yes, I am.
Okay, so I don't want you to read it out because you are the only one that is following for now. So just read it from your own end. Let me give you 5 minutes to digest it. Is 5 minutes okay for you?
Yes, it's fine.
Okay, so read it, and when you're done, so just read the question and digest it. The question is on the screen,
Okay.
but you can use your own because since you have it,
See, Yafa.
Yes, I have read it. Can you please give me 5 minutes? Maybe you can continue with the class. I want to quickly do something.
You are the one in the class now.
There is another one person there.
Austin is not really following, so I can't say I will continue now. I've not heard Austin's voice at all.
Okay.
No worry, I can give you your 5 minutes if you want 5 minutes.
Okay, please. Thank you.
When you're done, just beat me.
Okay, thanks.
All right.